A false sense of security surrounds home equity. It's not really yours until the cash is in hand through a loan or sale of your property.
Having equity is not enough. It's not enough to help you qualify for the best options. You can't assume your equity can speak for itself. On the surface, you would think people with more equity would get better interest rates. But the way the interest rate market works, people with the least amount of equity at times get better interest rates because their mortgages can be insured. You might be surprised to find out that you won't always be able to do what you want to do. A retired person with reduced income interested in buying a property might qualify for less with recent rule changes, and there might be increased debt and reduced income, and the strategy might have to change. Just like if you're late to the movies, you might not get the seats you want.
The simple truth is that the government's always changing regulations to have us being able to take less of our equity out. Staying on top of the market means getting in front of any government regulations to empower you to use your home equity where you see fit.